Hi guys and welcome back to Yashi. Today with a little different video. 2 weeks ago, the Federal Reserve released their statement where they said they're going to increase the base rate by 75 points or 0.75%. 2 weeks later, and they finally released the meeting minutes. They do it every month after the statement. It's basically a recap of what was discussed during the meeting. That gives you some general insights or things we can interpret about the future stance of the Federal Reserve. The way this is all structured is you have a few chapters about what is happening in the economy, the local economy, the international economy, what consumers are going through, what companies are going through, and then the final statement, which is what we saw then last week or 2 weeks ago when they released the statements. I'm going to try to summarize these 12 pages in 5 minutes so you don't have to read through the whole thing. I'm still going to give you the link to the site if you want to read the whole entire statement. So let's get started. So the market expected a 75% basis point increase on the past, let's say, meeting. And that's what the Fed also saw because the data is readily available. But the Fed also noticed that people are starting to focus more on when the Fed will start slowing down and pivot rather than how much the rate will go up. This is why, on top of getting data that started to, let's say, give information about how we can see inflation in the future. For example, freight costs dropping 70%, which could impact the CPI report, not of this month, but the next one. People are already starting to, let's say, calculate a 50 basis point increase on the next Federal Reserve meeting. And that, again, is included on this, let's say, file here. As you can see, 50 basis point expected. Let's go on with this section here. Volatility created liquidity issues in treasuries. So in the general treasury market, the Fed noticed that it is a little bit harder to exchange treasury notes and because of demand and supply issues, but the markets are still functioning pretty well. So even though the Fed increased everything, they're also starting to lower and sell their balance sheet off. There's still enough volatility for the markets, the treasury markets, to work properly. The strong Fed pace resulted in US dollar appreciating versus most currencies. Foreign countries in some cases had to go with drastic measures to fight their losing value against the US dollars. Some other countries simply went with interest rate hikes, like for example, European central banks. Then now the Fed is officially operating as a loss, as we can see here. We had deferred assets totaling 6.3 billion across 11 central banks, and many other banks are also facing negative net income. I call it negative loss, they call it negative net income. Now on to the next notes here, staff review on economic situation. The GDP was negative for the first 2 quarters of 2022. However, we had a positive GDP in the third quarter. So theoretically speaking, from a technical perspective, in the beginning of 2022, the US was in a recession, but it was never called. And we're now in a positive growth in this quarter. The question is, how will the Q4 look? We don't know, but we will see. The price index for consumption expenditures is still high. Unemployment is still going lower, on the other hand, as well as labor force participation. So on one side, we have inflation going higher. On the other, we have unemployment at amazing levels. On top of having the second problem, which is less and less people want to be in the labor force. We're losing people that are available and ready to work, on top of having super employment. So companies cannot really find people. Hourly earnings this year grew, but now at a slower pace than before, which is good news. So we don't want this growth to continue at a strong pace, or else inflation will continue to go up. The PCE, again, this price consumption index, was at 6.2% compared to September of last year, 5.1% if we only consider core inflation. Core inflation in this index is pretty much anything that has to do with inflation minus food and gasoline. Why does the Fed look more at this? Because food and gasoline are more volatile and more based on external factors, while consumption can be controlled more and more through the federal policy. And in some cases, some federal banks, local federal banks, actually calculated a core inflation of 4.7%, which is even better. We're still not close to the 2%, but numbers are looking better and better, which is good. And this is from the November meeting, so 2 weeks ago. I'm very curious to see what will happen on the next one. Credit quality in everything, okay, is still relatively good among companies, which is good news, especially after the whole FTX thing where we realized there was a lot of junk behind that. So I'm kind of happy to see that credit is still pretty good. US is operating under a trade surplus, more exports than imports, and foreign economic activity is slowing due to war, China crisis, and tighter central banks. In other words, the US is pretty much the strongest economy right now in the entire world, because on top of still operating pretty well, we have the strongest dollar. We have the strongest dollar that we ever had in the history of the United States. Now on to consumer credit and some general commercial credit. Mortgages went to historic highs after the September FOMC because we had still a lot of volatility. However, we all know from my last, let's say, housing update that because of the Fed decision and which pretty much met what people were expecting, namely 75 basis points, on top of a CPI report which came out better than expected right after the meeting, these mortgages dropped even more. I'm curious to see the 50 basis point expectation by people that we saw at the beginning of this video, if it actually will meet what the Fed will really actually do in December. But we're gonna see that later on. We're still seeing very good loans out there, although the cost of the loan is higher, so the demand is not as high. We're seeing some tighter restrictions on auto loans. So auto loans are not being approved as quickly as before, which makes sense. I'm actually happy to hear this because auto loans is probably the riskiest loans there are out there. It's a really questionable business. And I know that because I've been in the automotive business. Automotive loan standards are being increased, which is good. Corporate loans still seem to be fairly safe with low default rates, which is again very good news. Credit quality of most households seem to be solid. Delinquencies are still around pre-pandemic levels, so very good. The only sector with increasing delinquencies is auto loans, which are still yet around the same levels as pre-pandemic. So increasing delinquencies, but not that bad. The risky assets lost value due to sentiment and rates, but homes are still very strong. Companies are mostly deleveraging except for hedge funds, which means that companies are trying to get away from loans, paying off loans, which is good, which means companies are improving their balance sheets, which is good for investors and long-term outlooks, especially if a crisis should come, except for hedge funds and non-bank and financial institutions. So be careful with those, look at their balance sheets if you're invested in them. Inflation is still high, but mostly due to supply chain issues like the Ukraine war. Discretionary spending is down, which is good for inflation. People are spending less money on stuff they don't need. They're focusing their money on stuff they actually need, like housing, food, and gasoline. Households still have a good amount of savings, although some households are starting to have financial strains. So it's starting to hit more and more families. The more families it will hit, the less families will consume, the more inflation will be dropping because less consumptions will help inflation to go down. Companies seem to want to do anything to retain their employees to avoid their labor problems. This is something very important. So in the COVID times, we saw companies struggling with hiring people. And now that they finally hired some people, even if there could be a recession, after the lesson they learned, they will try to do anything they can to retain these people, even if they have to lose potentially money for a while. What does this mean for the Fed and for investing in general? This means that the Fed, which looks at employment and inflation data, will have to focus more on inflation. So if they want to slow down their pace, either they have to see a very good inflation number, or they have to see unemployment starting to grow at exponential rates. Because we now have companies literally stating that they will do anything they can to, let's say, not do layoffs, as they don't want to go through the same crisis they just went through to find people, it means that we might expect still a very good unemployment rate in the case there could be a crisis, which means that even in a crisis, if inflation is still high, unemployment might still remain lower, or might not react as strongly as it did, for example, 2008, which means that the Fed will mostly focus on inflation. And if unemployment still stays good and inflation is still bad, the Fed will keep its pace. So this is just a general opinion that I have, not financial advice, but I hope it makes sense. On to the next notes that I wrote here. Rent increases have been slowing recently, which is good news in terms of inflation. Main concern is inflation expectations remain high and above the 2% level, on top of the lagging effect of monetary policy. Raising too much now could have drastic effect in the future, but not immediate ones. Let's take away the rent part. Basically, one of the key things that people during the Fed meeting talked about is the lagging effect of monetary policy. Monetary policy has some immediate effect, like, for example, mortgage loans going up, but because it is slowing down credit and access to credit, making it more difficult, it can have longer term impact. If you raise them too high, you may not have immediate effects today, but you might have destruction in 2-3 months. So this is a thing that was mentioned only once after the FOMC statement 2 weeks ago, but in this file has been mentioned at least 3 times. They keep on talking about the lagging effect of monetary policy and how it's important. Is this maybe starting to, let's say, are they maybe starting to insinuate or between the lines say that they're starting to slow, let's say, sooner than we actually think? I don't know. We're gonna see that. Anyway, we're close towards the end. Economic expansion slowed down a lot, which is good. Hence a 75, but there's still a lot of growth, no matter the slowdown. So a 75 basis point increase is still understandable, as well as future increases in interest rates. The question is by how much. There's still a lot of uncertainty around the level that can be considered good enough for the Fed, and they want to focus more on that part of the equation, meaning that the maximum level they want to reach in federal funds rate compared to how quickly they want to get there. Factors to consider now, as I just aforementioned, is the cumulative effect of Fed policy, the lagging effect of economic and inflation data also. So they're starting to understand that everything has a slower effect. Data is not immediate. So the CPI report that came out this month is about October data, although we already know in November that many things are starting to deflate a lot. So the Fed will start to take into consideration that too. It's funny how they're pointing a lot about the lagging effects, the lagging data, the lagging this, the lagging that. This file is full of this. And I mean, for me, this is very positive data compared to the actual statement we saw 2 weeks ago. Because 2 weeks ago, the Fed released a statement that they're gonna put more attention into this, but then took it back immediately saying, guys, there's still a long way to go. And now they released this file where they mentioned this 5 times without saying, guys, there's still a long way to go. So, in my opinion, this is good data, but not financial advice. As I said, the focus is not the pace, but more the maximum level. And again, here, there's a lot of underlinement. What I just said is literally mentioned 1, 2, 3, and 4 times. And here we have a quick recap of the increases of interest rate and the focus. Another thing that will be mentioned only once here, the focus on starting to sell off their balance sheet and liberate their balance sheet, meaning take out liquidity from the market. And that is the thing that is, let's say, scaring me a little bit more because it will affect companies more, it will affect the loan market more. And I'm curious to see if they're gonna keep the promise of let's say, emptying out their balance sheet, or whether they're gonna keep a very full balance sheet and just focus on interest rate. Of course, it all depends on the data that will come out. Guys, this is all for now. I know it was a lot of information. I tried to cram it in just 5 minutes. I'll try to do my best on the next one. This is my first one. This is a lot of information, and I literally have been going through it for 2 hours. Thank you for watching, guys. If you like what I'm doing, please like and subscribe. Ciao!